All right, what's going on, everybody? How y'all doing? Kind of a boring day right in front of FOMC, but it's a busy week because it's the Mag 7 earnings week. Kind of a big deal. I've been stalking Apple for a while now. Apple's one of those companies that people love to hate. Oh, it goes down just a little bit, gets some weakness. Everybody likes to talk trash on Apple and just think it's going to finally be the time and run it into the dirt. And then those same people are buying it at all-time highs, talking about, yeah, Apple is just never going away. And it's been weak for a while. So it's been on my radar. And last week, and on that reversal in the afternoon, I went ahead and got into it. But it still got to report. Anything that has earnings means there's risk, elevated risk, extra risk that we don't necessarily need to take. If you look at the opportunity, we've got this half back at 266. So, you could wait until after earnings, let it get above that 266 level, and then, continue to push towards that previous high. Um, some of the concerns that I have for earnings is their spending. You know, this is one of the few companies that hasn't had the massive amount of capex increase for the whole AI build out. Don't get me wrong, they have spent money and it was wasted money. They've closed down so many divisions. They had that self-driving car division, they had an Apple car division, um, they had an AI division, and they've scrapped all that. Now they're talking about hiring out and collaborating with somebody like Google, so there'll be a spend there, but I'm thinking it's going to be less of a spend than what we've seen out of Meta, for an example, with their $1 million sign-on bonuses and just unlimited spending, or Google and Amazon developing their own chips and I don't know, just astronomical levels of spending. I don't think that Apple's going to see that kind of punishment, but there are still risks because they are going to have to do some kind of spending. Markets might not like that. And of course, their Siri still sucks. Like they don't have a working product as far as I'm concerned. Siri is just a completely worthless product and it's not usable, in my opinion. I'm an Apple user. So, it's not like I'm uh, just poo pooing on the company without having any real world experience. I have the phone, the watch, the tablets, and so does my wife, all three. So we use them, but we just don't use Siri because that's trash. They can make promises that they'll have a good working Siri this year, but well, we need to see it. You know, Markets might not like more promises on this earnings. So there's the iPhone sales. Whether or not they meet the hype. I know they had some issues selling phones last year because what did they really have to offer? A little slimmer of a phone? Yay. Still with a broken Siri in it, that's junk. So what if they don't have the level of phone sales that everybody's looking for? That could be another reason that it sells off pretty hard. But even if it doesn't meet expectations for this earnings, I still expect to see good things from Apple this year in the charts, which is why I I took the trade long and I'm willing to hold into this earnings because I think that even if the earnings go bad and say we break underneath this pivot, I think on the rebound we'll come up high enough that I'll be able to get out, and not get hurt that bad. I don't think it would be just a beat down without any mean reversion. Take this, smack down from back here. It still bounced off of support and rallied into resistance and then failed again. So, I'm expecting that sort of a rebound, even if things go wrong. So we'll have to see how it plays out. But I do like Apple for the year. And sure, it's been heading down since, the end of the year. Certainly got issues, but I mean it's Apple, Look at that. And you put it out on a monthly, this pullback is nothing compared to this or even back here, in that 2022 bear market that we were in, or even back here. So, yeah, I'm not too worried about it. Even look at last month's candle, right? If we was to snap, well, not last month, the current month's candle, we're really close to that midpoint. I'd like to see this candle close above that mid by the end of the month. And we've still got earnings and FOMC, and we'll see how it plays out. But yeah, I like Apple. I think it's got room for improvement. The other mags, a lot of them, anyways, are going to be reporting this week. One of the tools that I like to look at when it comes to the Mag 7 is this ratio here, IWF, IWD. Now, technically speaking, this is just a growth versus value ratio, and it's a really popular one. But what we kind of came up with over the years is that it's really good at spotting not just a generic growth versus value, but more specifically, Mag 7 strength or outperformance versus the broader market. So when this is going up, the Mag 7 is preferred long opportunities and they're outperforming the broader market. When it's sideways or going down, then the Mag 7 is underperforming the broader market. So I don't like to look for new long trades when this is headed to the downside. The concern is that at the moment we've just got this little bump. Well, that don't mean anything. We had a little bump here too, and that didn't get very far. So we could end up just, stalling out here and heading back down. And this white dotted line is the year to date anchored VWAP. Of course, it's a new year, it just got started. We're very likely going to cross back and forth through that level. And it very likely won't have any respect for that line at all since it's so new. You know, that I don't expect much out of it now. Every tool has a weakness, and anchored VWAP doesn't do a very good job in the first month and a half or 2 months. It needs time, right? So that really just doesn't help at the moment. But we're on the move to the upside and got to keep our eye on it to see if we're going to make that 2.2. That was a really big level from previous times like 2025, way back here before all the tariff talk and the weakness. So maybe we get back up through that level. Maybe we reject off underneath it. Don't know. But for the growth versus value, at least it's pointed to the upside now. That's a good start. Now, this is the MAGS ETF. It's kind of a newer product, all things considered. I mean, if we scroll back, you can see it's new. It really came out in '03. This is '04, the whole year, and then '05, another year. But it's really new. Collectively, this ETF keeps you focused on how they are doing as a group. And there's plenty of traders who watch the individual constituents of the Mag 7 and they'll play them against each other. I don't remember which group is which, but an example would be, oh, Tesla's going down, so Nvidia is going up, right? Or Nvidia is going down, so Tesla's going up, something like that. I know that's not the group, right? But I know a number of traders who trade it that way, that they have this expectation that all seven very likely are not all going up at the same time. And that inside the group, if something is strong, then something else will be weak. I've heard a lot of arguments about it, and their theory makes sense. It just seems like it would be such a headache to try to figure out which is which, and you'd have to put some work into the money flow. That's, to me, that would be the key to all of it. The money flow and the volume, which ones get the positive volume, and when they do, who's getting the negative volume. And that way we can watch for the money flow inside the group of seven. It's a bit much for me since I don't like to day trade these on a daily basis and I'm not rotating in and out of them. But if you are not futures trading and you want some short term equity trades, that might be something to really consider. Between the uh, single stock ETFs that represent these names and the group of seven inside this, I think you could make a real career out of it, really. But I got futures and options and stock and every darn thing in between, so I don't need it. They are headed to the upside, though. You can see we're on day 5 now. So, I have to worry about the 5 bar rule. It's not set in stone, but it's something that I would be concerned with. And the day isn't done yet, but the 5 bar rule suggests that after the fifth bar of the same color, your chances of seeing another bar of the same color go down radically. You're more likely to see a doji or a reversal bar, opposite candle color. So the mags are looking good. They're on their way back up. If we measure the range, you can see we're back above the half. So we're through the riskiest part. One of my concerns right now is all of this selling and whether or not we're done. There could still be a lot of negative liquidity here that we have to work through, and we won't know for sure until we make it through, right? But I would not short the Mag 7 with this backdrop and this backdrop. You put those two pieces together, and that's saying don't short the Mag 7. Not right now, right? All right, so this is what they often call the flight to safety ratio, XLY, XLP. Oh, that's really cool. Kevin just shared a volume profile video, how to use the volume profile on TradingView, the day trader's guide. Very cool. So in this ratio, we got growth. Well, let's say it another way. We got staples versus frivolous spending. I like to say it that way. So hotels, casinos, cruise lines, fancy cars, fancy computers, fancy phones versus peanut butter, toilet paper, soup, that sort of stuff, right? Staples versus frivolous spending. So when the broader economy is weak, when people are fearing their jobs and struggling to get by, then of course we expect staples to do better. And in a expanding market where people are willing to take risk and they're comfortable in their job and they're uh, spending money on hotels and vacations and gadgets and gizmos, then we expect consumer discretionary to do good. They call it the flight to safety because when things start to go wrong, we will see a rotation out of that consumer discretionary and into staples. Unfortunately, if things go really wrong, they'll dump that too. right? We've seen that happen in the 2020 sell off when things got really bad. But generally speaking, it doesn't happen like that, right? So when times are good, this ratio points to the upside, and when times are bad, it points to the downside. When it comes to using these ratio charts, by the way, what I really recommend is to have a date in time that you know was really bullish or really bearish. In the current landscape, the April low of 2025 was a really negative market. And that makes a nice benchmark for any ratio chart that you pull up when you're trying to figure out, how do I read this damn ratio? This is a weird one. I don't know this. What is it? The first thing you want to do is find a very positive or a very negative backdrop that you know and remember. Now that's hard for new traders because maybe you wasn't here then. But if you don't have one, this is SPY, and that's April of last year when the president started really hammering out a lot of talk in tariffs, when people realized that he wasn't joking, and then when the bond vigilantes got him to capitulate, bend the knee, and turned everything around and started running it back up the other direction. So we know what bad looks like. Orale, did something happen? You guys don't hear me no more. Ah, no? Oh, yeah, I mean, it's possible. Probably don't want me coughing in your ear. But I didn't hit mute like, that was me deliberately muting, but otherwise I didn't mute it. So that's my recommendation. If you start pairing names together and you're making up your own ratios, and there's nothing wrong with making up your own ratios, but you need a benchmark to set it to. Like, what does bad look like? What does good look like? Highlight those areas or pinpoint those areas on your ratio chart so that you have that benchmark of good and bad. Because some go with the market and then some go against the market, and they kind of do their own thing. Just remember that this ratio, for an example, is not growth or value when we're analyzing it. Instead, it's which one is outperforming. Is growth stronger than value? Because you can have growth and value both going up. You can have growth and value both going down. What we want to know is which one was stronger. Was growth outperforming value or vice versa? That way, if you look at XLY and then you go and you look at XLP and they're both moving up or they're both moving down, you'll still understand why the ratio is going higher or lower, because one will be outperforming the other. So this is weak, and we knew that, right? We've seen the Mag 7 sell off into the new year. We've seen all of them suffering, and we've seen a little bit of a rally here and here. But look at that. It's pointed down, huh? So we might be rallying in the Mag 7, but this says Staple is doing better than the Mag 7 in these last few days. That's Thursday, Friday, Monday, Tuesday. Staples is outperforming the Mag 7. That kind of makes sense when you think about it. Do you really want to get a trade in the Mag 7 when they're going to report earnings this week? Probably not, right? Maybe sit out, let them report, and then trade after they report. That makes more sense. And so that's, at least in my mind, some explanation for Why why this, right? And I get it. And you're going to look at ratios sometimes and you'll be like, I don't understand. Why are you doing that? And maybe you don't get an answer and that sucks. But when that happens to me, I just don't trade it, cuz like it's not doing what it's supposed to, or it's doing something I don't understand, and that just warns me to stay out, protect my capital, and don't get involved. I don't have FOMO issues. So, you know, I got rid of that button. This is a newer ratio that I'm still trying to build a relationship with. I don't have it yet. So it's a new ETF, the MAGs. We already talked about that. It was back here. This is the MAGs. And then it's top T. Now, top T is the top 20 names in the NASDAQ. That sounds pretty good, right? In my opinion, it's basically the MAG 7 and then the other 13 names too. And that way you can have a little diversity. I would really like to have an ETF that was the top 10 or the top 20 in the S&P, right? Because the Nasdaq is the Nasdaq is the Nasdaq. It's tech. It's always tech. It's just tech. But the S&P has more diversity, and I would like a little bit of diversity in there. So, someday I'll find just the right combo. But I've been using this, and it's a lot of sideways, as you can see. Got a really strong range, and I'm getting comfortable with the range. I got to admit, it's growing on me. Because if we leave this range, I know that we've finally resolved something that we've been working on since September. It's been a rough couple of months. Yeah. Almost 6 months. It feels like half a year. I don't know. Added up since September. Pretty close. Pretty close to 6 months. Someday we're going to get out of this range and we're going to get dominance. And when we do, I believe that this ratio will highlight that opportunity. For now, it just says we're in the same boat that we were in December, in November, and all the way back, right? Like, okay, nothing's changed. It's same old, same old. And we can go back to August or April to the tariffs and all that. So we know what bad looks like. That's what bad looks like. And if you look at where we were before things got bad, it's the same darn area that we're at right now. So 205 or 210 is the low edge on this ratio for right now. I haven't put lipstick on a pig yet, but at some point we're going to have to add all the lines and make it pretty. I think 210 is a solid level. When we get underneath that, we know things are getting really bad and that we could have something like that. Think about this chart here into December and January and February of 2025. December, January, and February of 2025. Doesn't look that bad, right? Some weakness, some pullbacks, but we're still, breaking ground, new highs, holding our own. Everything felt like we had more to go. And then, uh-oh, but this warned us at the end of December with that big drop, and we didn't set new highs here. We did in SPY, we didn't here. Significant divergence. So I like this. It's growing on me. Um, it's not a daily thing. You don't have to come in and stare at it all day long, but I think it has a lot to offer as a ratio. And I don't know, I keep it around. Right now, it's pointed to the upside. So the Mag 7 is at least outperforming the other 13 names. But we know from this that Staples is outperforming the top 20, right? And the top, the mags too, but definitely Staples is outperforming. Oh yeah. I've always got it. It's always there. Now this isn't US dollar Japan. You have it backwards, but I know what you meant. It really is important that you put it in the right order though when you're looking at the chart, or you'll be looking at something opposite of everybody else, right? But I knew what you meant. No worries. But before we get there, you want to look at the JGB 10-year, right? Because what the JGB 10-year is doing is going to greatly affect what's going on with the yield and the yen and the carry trade unwind. And I'm still a big fan of the argument that repatriation is changing and that the yen carry trade won't unwind the way that we're used to seeing it unwind. All right, US dollar Japan. This is the way that you want to look at it. Now, you could flip the numbers by going Japan US dollar, but again, you won't be looking at what everybody else is looking at, right? So, this is what we've got right now. They have stated that they're looking for intervention, and it's very likely that the US is going to participate in that intervention. The Fed will coordinate efforts with them. Sometimes they do that, sometimes they just do it on their own. And you can see that there's a significant move here, and it broke the 158, 157 area that was supposed to be a key level. 156 was like the one standard, or excuse me, the two standard deviation point of no return, and we're past that too. Like, it's just a big rowdy move. So that looks pretty bad, all things considered. But we're not seeing the effects that we normally would see. If we go back in time, probably can't do it on that time frame. See, 2020, it would be right there in the 2022 bear market. That was their intervention that they did with the help and support of the US. And we had that significant move in the US dollar Japan, right? Now, if you mark that day, and they swore at the time, right? We didn't intervene. What are you talking about? No, of course not. I've got a video that I did on this. I don't know if I ever made it public. It definitely, my client's seen it. October 20th, 2022 bear market. So come back over to SPY, rewind to October 20. I need more days, right? I need more years. This is the 2022 bear market right in there. October 1920, right there. That was the day, right? Now I'll argue that it was actually here, but that day, the 20th to 21st, it was like 9:45, 10 a.m. in the morning, and we had this explosive move. 3 days of just nonstop ripping, right? Before we finally stalled out. It was significant, but not this time, right? And it's funny with long-term analysts, they're always arguing if this time is going to be different. Not in Japan dollar ratio, but in anything. Anything that they're analyzing and they're talking about, and they're say, yeah, in the past it did this and this and this, but I wonder if this time will be different. And a lot of times they'll argue, yeah, this is different this time. And then, it ends up not being different. It's the same old, and it's always the same old, same old. But maybe this time is different. The difference this time is where's the money going? Usually in the carry trade, what do? They sell the dollar and well they sell the yen, they buy the dollar and they buy the Nasdaq. Basically, right? They use their dollars to buy the Nasdaq just to keep it really short and sweet. And if they go to unwind that, then they sell the Nasdaq, which gives them dollars, then they sell the dollars and they buy yen. And that would be your unwind of the carry trade. The problem is they've been selling the yen and they're not buying the dollar with it. They're buying gold. Or they sell their Nasdaq and they take the dollars and they go buy gold and silver. That we're not repatriating. Money's not going home. It's not going to the yen. It's going to gold and silver, precious metals. So if we're starting to see a significant unwind, where's the money going to go? What are they going to unwind? If they need to go in and buy yen, because yen is falling, what are they going to do? What are they going to sell? Gold? Silver? So this is US dollar Japan. They're buying the yen. That's why it's going down, right? If they were buying the dollar, this would be going up. But they're buying the yen, so it's going down. Where are they going to get the money to buy the yen? They're going to have to sell something. Look at what the dollar's doing. Looks like the dollar pooped a bit. So they're selling the dollar and they're buying the yen. That makes sense. That's what we expect. But where are they getting the dollar? They're not selling the Nasdaq, right? Nope. Gold? Not really. You know, like really, not really. They're not selling it. Silver? Maybe a little. So either they were just hanging on to a bunch of dollars and they're selling it now, or they're going to need to sell something to get them those dollars. Keep your eye on the dollar to see when the dollar stops falling. That'll tell you that they're out of dollars and that they'll need more dollars. At which point, if they want to keep selling the dollar, they're going to need some. They're going to have to sell gold or silver or NASDAQ to get them dollars so that they can sell those dollars to buy more yen if it keeps going. All of this can get really confusing. And the main thing is you don't have to understand it all. You just have to recognize, is there extra risk that I need to be concerned about? Yes. If you see the dollar making big moves up or down, then you've got something to be scared of. There is elevated risk. If you see the yen making big moves up or down, you've got something to be concerned about. There is risk. That's the highlight, right? That's the main takeaway. so that even if you don't understand everything that's going on, you can see that and say, "Oh, damn, I need to tighten up my portfolio and maybe put some hedges on, or reduce some of this risk. That's some bad stuff going on." Yep, that has worked out for me pretty good over the years because I can tell you I don't understand everything that's going on a lot. I end up having to read a bunch of articles or dig deeper into something. Sorry, I can't type and talk. I can't chew gum and walk. So we are seeing some risk. There is talk of coordinated intervention with the Fed and the Japan government, and it is not playing out the way it has in the past. Those are the takeaways at the moment. What will become of it? Honestly, I have no idea. That sort of move to the downside should have popped us hard to the upside, and it didn't. It's a good thing we weren't trying to trade it that way. But I also remember back in that 2022 bear market that we had a significant low before that intervention too. This is the 13th. It was 10/13/2022, and I know cuz one of my family members' birthday is that day. And I believe it was a Friday also, but it was no, it wasn't a Friday. But it was a big day, big outside bar, massive reversal. And I bet if you go back to that day's live stream when we were gapped down hard in the pre-market, that I was talking about what a fantastic up day this was going to be and how we should be looking for longs and rip that sucker. Maybe I'm wrong, but I bet I was talking about that in the video because I like those very solid down days at the bottom of a range like this. This is like such a gift. What an amazing chance to trade. Oh, I'm going to have to go look for myself now. Not now, but sometimes I like to cut excerpts out and say, look, like a broken clock, I got that one right. I'll just have to go back and look. Um, they have a history of straight up lying to our face also. If they are intervening and they're being asked about it, they very likely are going to say, "What are you talking about? We're not intervening. We didn't do anything." And they'll hold that lie for days until they have to publish their uh, monetary movement, and then they'll say, "Oh yeah, you know what? Yep, that was us. My bad." So you can't trust them if they're saying that they're not doing it and they are doing it. They'll just lie. But their lie only holds for a few days, right? Like maybe a week at the most, and then they have to admit it. You would think it'd be legal for them to lie like that, but nope. So some charts that you can use. Thinkorswim has some. They don't really have them all, and you can shop around on TradingView and find some really good ones. I like the JGB 10-year. This is the Japan 10-year government bonds. I really like this one. If we go back to the 2022 bear market, You can see how they were really holding it there, right? Let's get to 2022 right before the drop. July, September. Oh, come on. Zoom in. There we go. August, September, October, and then where's the intervention? Nah, that's not the one. There's another one where they were holding yields right at a particular level. And there's a great chart for it. I could have swore that was the one that we needed. Maybe they are doing some selling in the gold silver space. That's a heck of a reversal. Let's see. Hold on. Well, what? I don't have it. If I don't have it, we're just gonna have to go look for it. Get off there. All right. Well, you should always have this one. This is the ETF for the yen. That way, you got the US dollar, Japan, and then this is just a regular, just like SPY. So if it goes up, they're buying it. If it goes down, they're selling it. It's not inverse and weird, so you don't have to try to remember the direction of the ratio pair that you're using. FXY is a really good one to keep track of. Plus, you can trade this. So that's good too, right? It's FXY. Always have that one. All right, we'll just have to look. You can track this. It's like tracking our rates, right? If they raise rates, if they cut rates, how many more rates do they need to price in? It's not as good as like the FOMC um, Fed Watch tool where we can see their projections, but you can see, and we have one of these for the US, but that's JPINTR. That's some good music. Oh, I see. That's in my headset. Hold on, I got a phone call. All right. I get this shot that gets delivered in the mail, and they always have to coordinate the delivery because it's got to stay on ice. And they always have to call and get it figured out. All right, even though these numbers don't look right, I'm pretty sure it's this one, JP10, right? It's the one that we were already looking at. They did a significant amount of work to keep this thing buried because they didn't want this getting too high. Now you can run this doesn't have the Y on it. So you can run JP10 or JP10Y, add the Y on it, right? That's the yields. So go back to the same time frame. But I had a chart that was all decked out with lines and drawings. I'm gonna have to look for that because if we were pulling it up, my lines and my drawings would be there. But if they do any intervention, you can see how that shot to the upside. That was them fighting it. If we go back to the other one, JP10 without the Y. And then they changed things. They said, you know what? We're not gonna stop it now. We're gonna let it go, and we'll use higher levels, which is why we started to climb and climb and climb, and now we're way up here. But they've gone through a number of prime ministers since then too, and they keep quitting or getting replaced, and the decades long system that's been in place is gone. And they've decided to join the rest of the world, and they're going to spend their way out of debt. Does that sound familiar? Because that's what the US and a lot of countries around the world are doing now. Got debt? Just keep spending. Spend your way out of debt. Don't try that with your own home finances, by the way, right? Like it's not a recipe for success. But that's what Japan is doing. So the main thing, keep your eye on it. If it starts making significant moves, you know you've got elevated risk, and keep your eye on the headlines so that you can see comments that are being made. I get it. They will lie. That's a given. But that way you at least stay current on, you know, interest rate decisions, upcoming meetings, that sort of stuff. Well, it made sense for almost a decade with the idea that there was zero or really low interest rates in one area and really high interest rates in another area. So you could, borrow money in one spot basically without paying any interest at all, and then you could use that money in another area of the world and you could get a nice return even just on the interest alone. Think of, and I know that banks in the US don't offer anything for the interest on your money, but take a fixed income trade where you're getting, I don't know, 6% returns on money. So you give them 50,000 and you've got a guaranteed return of 6%. It's not awesome, but it's okay for fixed income. 6% is not bad. So what do? You go to Japan, you borrow a boatload of money with basically zero interest to have to repay, and you take that money over to another area that's offering 6% and you dump all that money into it. Even if Japan's charging 1%, if somebody else is paying 7% or 6%, then you take the money that you made on the interest from one area and you go back to Japan and you pay that low interest on the other one and you just leave it there. It's the carry trade. You just carry it forward and carry it forward and carry it forward, and you're making a guaranteed return until things go wrong, right? So that was the old system. That's the old way of doing things. When Japan had low or no interest rates, then that was the system. But now that's gone or it's getting unwound. And there is no such thing as free money, that you got to pay interest. So we need a new kind of regime. But now we got these wild moves in gold and silver and precious metals, and it's kind of indicating that money isn't going home. So where the heck is it going? There's gold. No more free money, right? That's the takeaway. Well, that's a really interesting post. Here, let me share that. This is um, a really fancy highlight of today's events. It doesn't really matter now. The day is almost done, but wow, that's fancy. Isn't it though? That's loud. For those in the replay, let me bring it up. You can see it. Whew, that's pretty. Somebody took the time to make it. Somebody shared it with me. I don't know where they got it. I asked them, they haven't answered yet. Yeah, it's neat. I'm just glad I didn't have to make it because you make this something like this once, and everybody's going to be there every day. Hey, you got another one of those? Oh my goodness, qubits, the D-wave quantum. I was talking to AI today, and it made this offhanded remark about, "Do you want me to check the options activity and get some premium prices?" And I was really surprised by that comment. Like, wait, you got options data? And the answer didn't necessarily convince me that what I would get would be worthwhile, but the fact that it was offering me some options analysis was interesting. I'd say by the I would say by the end of the year, it probably will be able to offer live data. I was just taken aback by the offer. It was like, hey, you want me to look up the options? And I'm like, wait, you can do that? I'm trying to find what its response was when I asked, you can do that, and it said I can do blah blah blah, and some of it was 0 day. Some of it was able to calculate the collar, so today's expected move range, and it offered me today a calculation for the call walls if I wanted 0 day call walls on various equities, and I was impressed. I gotta say, since it wasn't designed by one of the brokers. Here's what it said. It said, "What I can do for you right now, I can pull current quotes," and this is on random equities, right? So not necessarily on just the Qs or SPY. I can pull current quotes, scan for unusual activity, calculate the Greeks, and identify 0 day levels. I can find the current expected move based on today's straddle price and estimate the delta or theta for a specific contract. Can look for high volume or unusual open interest at specific strikes. Wow. Yeah, I believe so. Yeah. Speaking of options, the IBIT and the MAG 7 now have Monday, Wednesday, and Friday options to be traded. Yeah. One step closer to having 5 days a week in IBIT and MAG 7. Wow, my thinkorswim just froze up on me there for a moment. Take out the trash. No, I agree. I think they throttled back our access to the servers, and I think they're allocating those servers for their in-house models and tools, and that leaves the rest of us kind of hanging. I don't like them as a company. When I reached out about futures, because we used to be able to trade the futures here with a reasonable margin, reasonable in relation to what all the other brokers who aren't tasty or not tasty, but Tradeovate and Ninja, they did. They don't anymore. Yeah. Yeah, I called them and I said, "What's your new day trade rate?" And they just flat out said, "We don't have one." I said, "Well, how do you expect to get traders in there?" And they flat out told me, "We don't want your business. We don't need the turnaround." Okay. I mean, at least you're honest with me. You don't want my business, I'll take it somewhere else. So if you want to, yeah. So there's two groups of brokers, what I will call fixed rate brokers like Tradeovate and Ninja, and then the rate adjusted brokers, which is basically everybody else. ROJ Futures, Schwab, TD Ameritrade, all those, everybody who's not one of the fixed rate brokers. What it used to be for the typical brokers was 10% and or 25% if they were, being a little aggressive. They might want 25%. And that's just buying power, right? So if the ES contract was $2,549, if that's what you needed for the MES, then they'd say, all right, well, you got to have, 10% of that as a buying power and you can day trade. Or you need 25% of that and we'll let you day trade. Schwab said, you know what, we don't really care if you trade here or not. So we want 2,500 if it says 2,500. If you don't like it, take your commission somewhere else. So, oh yeah. And that's all I was looking for is I understand the government makes them set a certain rate. And so it can't be lower than the government's criteria, but it can be higher. The government says you need at least 10%. A lot of brokers say I want 25. Schwab just straight up said I want 100%. And they're on the hook, right? So if they offered you a chance to day trade at 25% and you just blow up to hell and then you decide to sue them, well, now they got to fight you in court and blah, blah, blah. And they just would rather not. So they figure they'll just save themselves a lot of trouble and drama and headache and turnaround if they just don't take your money and they don't get involved in the headache. From a business standpoint, it's not necessarily a bad idea. Who are they turning away? Just the average retail crowd, which, like we've all discussed, they can't compete with Tradeovate and Ninja anyways. So why even bother? And they just washed their hands of it and said, we don't need it. We don't need your headache. I don't fault them for it, but I was at least looking for the average, the government standard at a minimum. But they just said nope. If you want a very sophisticated platform, um, ROJ Futures is one. I had a relationship with these guys for quite a while. Um, it is a sophisticated broker, though. It is not your typical trade of eight platform, and you will get someone on the phone at ROJ Futures. But this is not a trade of eight type broker, right? This is one of those fluctuating rate that is going to be mandated by the government with that minimum market margin requirement. They've got a sophisticated platform. I believe so. Yeah. Yeah. The platform. Think of Thinkorswim. It's an all-around platform. It'll do just about everything, right? You can trade pairs and all of it. That's ROJ futures. It's sophisticated. You can do way more than just get in and get out with your basic Tradeovate type portfolio account. It does so much more. I haven't even logged in there because I closed my account with them in 2021, late 2021, and they were talking about upgrading their platform. So I don't even know what their new one looks like. But you got choices here under platforms. I noticed the real GDP ticked up, right? The between SAR and recent change. Still waiting on the official release because there's multiple, GDP metrics, but I think we're gonna see a little bit of an uptick, and that's cool. 2026 is looking like it has a lot of opportunity, but there was an analyst who was talking about, he did mention a little bit of waveform, so I'm going to skip past all of that part. But his comments about are we in the start of a bear market really got my attention. Gold just made some moves, by the way, after hours after it closed. Um, I think this last move in SPY negates the analyst's argument, but he was arguing about this gap down day. So I'll just stop my chart right there. He was talking about this gap down, and he's like, this might be the start of that new bear market. And he was talking about how it would last into October of this year, and yet we would still come out of those October lows and have gains on the year by the end of the year. So, a significant rally between October and December of 2026. I think this move back up scratches his argument off the table, but I'm going to need to see a new article from that guy before, you know, I don't want to put any words in his mouth. Maybe he's going to argue that it's still on the table, but he was making a really good argument that this move was the start of a bear market cycle. And I don't know. I think this new high scratches that off the table, but we'll see. I feel really good, guys. That I called this Monday morning, that if we broke to the upside, we'd want to run it to the weekly expected move. We're not exactly there yet, but gosh darn if we haven't given it a good run so far. If you took those options, you should have been killing it. You know, Technical analysis is a really great tool, but it's only one piece of the puzzle, right? So this work is fantastic. One of the great things about this kind of work is that you will slowly develop trust in yourself and your ability to correctly identify turning points and direction and distance. That trust in yourself is the key to all of it. And without it, so many traders fail. So you're going to really have opportunities to grow the trust that you have in yourself with this kind of work. The outcome of trades, however, needs more than this to start the trade, stay in the trade, and then finally exit the trade. The chart does not have all the answers, at least not the one single chart of the product that you want to trade. So you want healthcare ETF. You want some peers that match UNH in the moat and the space that it resides in. Headlines on this product, short interest, any filings that they may have about dilutions or mergers, acquisitions, anything like that, right? Dividend. So there's a lot of information that you want to bring to the table so that this isn't the only source for your analysis. That will help you grow trust in your understanding of how we got to where we are and what we expect will happen next. Don't get me wrong, you're still going to be in a position a lot of times where you're like, yeah, hell, I have no idea. Maybe we go up, maybe we go down. But sometimes you're going to find information that will be so glaringly obvious that they're like, oh, hell yeah, no, this is clearly a short or it's clearly a long. And you'll know with confidence that you're on the right track. Those are the best, right? You get enough of those and you really get to the point where you're just avoiding the wishy-washy. There was I don't want to pick on the guy. I certainly don't want him to feel picked on. There was a conversation in the questions channel the other day about a particular stock, and it was one that I didn't know. So of course, the first thing I did is, well, it's not that I didn't know. I didn't have any background on its current situation. This ABP, and I thought, well, the hell is ABP? Yeah, yep. I don't. So I did a little digging into this APB because I don't know what the hell it is. And Turns out it's in a classic. Now that was Whirlpool, WHRL, Whirl. This one, this thing is in a classic death spiral. It's crashing, and there's no saving it from the brink. Right? It's just I learned so much about that company with a quick little AI search about its background and what it's doing with its shares that it was so glaringly obvious that, hey, leave this sucker alone. It is trash. Wheeler Real Estate Investment Trust, WHLR, one of those most volatile and complex small cap REITs on the market. This thing is so broken that I didn't even need to continue looking at the chart at that point. It was like, oh hell no. You couldn't pay me to take a trade in this thing. So that was so obvious. They won't all be such a gift. But if you do a little poking around and you find something like that, and you're like, oh yeah, no, I'm good. I know what I need to do. I need to run away as fast as my legs can carry me. I need to go away from this. Well, what if it's the other way around and you find something that's just so amazingly awesome? Just like, I have the chart, I have the setup, the measured move, and then I just found all this really great data. This is obviously a buy. You know what I mean? Like, you're going to get it both ways if you look. And then a lot of times you're going to be stuck in the middle and then you won't find that data and it just won't be there and there's no extra help. But if you find it because you looked, then awesome, right? It's great. The system is designed that they get the stock out there, they sell it to the public, that makes them money, right? They need money. They can go to the bank so many times and get a loan before the bank says you got too much loan risk. We're not going to give you any more money. So what do? They offer shares to the public. They get people to buy the shares, and if they have a lot of shares to give to the public, then there's a lot of shares that they can sell, right? So dilute the stock, sell a lot of shares, and then get the pump going to get the stock price up so that they can split it, double all the shares that they have, drop the price back down into the dirt, and run the whole thing over again. These stocks are what we call event driven opportunities. So when there's an event or a reason for them to pop and move, then you strategically get in and out. Without that, we don't trade them because it's not about technical analysis. It's only about the short squeeze, the push to the upside, and the very short opportunity to take a trade long. You don't even want to short these things. Don't do that. To get your long trade on, get in, get out, very nimble, and then look for the next thing that is in a short squeeze that's going to get another pop. That's it. It's all event driven opportunity. If you trade this low float stuff, you have to understand that. It's not technical analysis and any of that. It's just the events. So if you can plan your schedule and your calendar, you recognize these names in advance, who's got trials that are coming up, who's got another drug that is being offered, who's getting bought, who's being sold, M&A deals, all of that stuff. That way you're in the know. Without it, every morning, what do? You come in and you look at what has already moved at 4 o'clock this morning, what popped, what dropped, and you're stuck trying to chase it after it's already made big moves, thinking maybe it's going to make more moves today. And that sucks. The healthcare changes, UNH was already an at risk play. It has been since the beatdown, right? When the CEO, the whole shenanigans back here, and it was under the half, it was struggling. If we take that half and we look at it, then we're in this one down here. And then we have another half to measure here, right? So we had a lot of zones to focus on. We were back above that one. We were holding still above that one, right? And then we're still underneath this one. So we're in this risk zone, anyways, because we're under the dominant half. We were doing good because we were on the turnaround side above this lower half, and in the current micro zone, we were doing good here. But that's an earnings. Earnings are always risk, right? So earnings are earnings. When it comes to earnings, there is absolutely no way to tell what direction the market's going to go. They could give the best earnings that's ever been given in the history of the company and then say, but our next quarter, we're going to do a lot of spending on blah, 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 whatever. And boom, down it goes. Right. So they keep that a closely guarded secret about what their forward earnings is going to be. Of course, they can't hide what they've already done, and they can't hide orders that are on the books, that sort of stuff. But when it comes to their forward guidance, companies keep that closely guarded. And when they announce it, that's usually when they get the face plant. And that's what we got here was the face plant. So, it's not a surprise, and you nailed it. It wasn't alone either. All right, a lot of companies, and there was some headlines that went with it, and maybe the entire space is going to struggle for a while. But this was what we would call a hedge fund hotel for a long time. Money would get parked here for just, I mean, look at that run from 2008 and 9. It's just been on a climb, and it was a slow mover, but it was a place for them to park their funds, and it was safe, it's comfortable. Well, all that is gone, and we've had significant changes now, and it's a broken system now, and that means it's in a different category than it used to be in. Can't trust it the way we used to. I would be strategic playing this. I would not use it as a buy and hold play or a long-term investment theme or anything like that. It would be nimble, get in and out, and be mindful of its earnings. Now, I'm in Apple, and Apple's going to report this week. So, you know, yes, you can trade during an earnings announcement. You can, but you really want to have confidence in the company. And man, when it comes to healthcare right now, I have no confidence in any of them. And I've got a guy that helps, right? Have a person, um, a specialist. A really good friend of mine is a doctor. He's an actual, you know, real doctor that has clients and everything, and he's a trader. So he is my go-to guy for any questions that I have about any medical stocks, whether it's biopharma or just different drug trials or anything that has to do with uh, Congress and healthcare and any of that stuff. And he's big in politics too, really big. He knows some. Um, I was shocked at the people that he knows. So he's an excellent source, right? You might not have one of those just sitting around at your local coffee shop, but at some point try to grow your resources of the people that you know so that you can find somebody in an area that has a particular expertise that can help you out. Because I avoid healthcare and biopharma stocks like crazy most of the time. Now that I got somebody that I can ask questions to, I have dabbled a little, but I'm not comfortable in this space. I'm not one for the pump and dumpers. I don't care for low float cheap stocks, and I don't really appreciate the healthcare hedge fund hotels that used to exist. They're just not my bag. Yeah, I mean, this used to be a safe space, all things considered. I mean, that's not something we would generally call stock trading in general being a safe space, but there are companies where money goes in times of crisis as just these big funds and institutions, they pay a fee or a fine to go to cash. So if the market gets raw and volatile and dangerous, they don't want to go to cash and then have to explain to their clients, hey, I lost you 4% last year, not because I took risk, but because I went to cash. If you're going to lose my money, at least tell me you tried to do something with it, that you didn't just roll over, show your belly, give away my money for nothing. So, like this, hedge fund hotel is the phrase for it. They're not something that you would want to trade as a long opportunity, and you get out of it as soon as the risk that you were worried about has passed. But there's a number of those. That's what this used to be. And your timing is right. Up until last year, it was fine. And then everything went to hell, especially with the changes that are being proposed in the House and the Senate. So the hedge fund hotels, they don't generally change that much. It shouldn't be too hard to find some alternatives. They may not be in the same space. I think some of those old school oil ones, like ConocoPhillips, I believe, is one still, um, or one like it. What's that other one? It's really old school oil and gas industry. Oh, yeah, something like ConocoPhillips, ExxonMobil. It's an old school company like that, but those are still considered hedge funds hotels to a point. It's a safe space for capital in a short-term environment. And this one fits the logic since it's in the energy space. What do we typically fear with energy is cost going up, not down. So this tends to do well in those negative environments, all things considered. But they're those kind of old school big names. Um, Maybe J&J. Yeah, I mean, if you look at J&J from '09 to our current market, you can see in times of trouble, think COVID 2020 or the bear market of 2022, look how it performed. All things considered, that's not that bad. That's another example of those hedge fund hotels. But in that flight to safety, look at this, you know. Yeah. Look at that outperformance. Me NEE. This thing's been sideways for a couple of years. Funny enough, I like Walmart because I still think it has room to grow its online services. But Walmart is one heck of a place to park capital. But these aren't momentum trades. They're not trend trades. They're just places to put your capital in times of uncertainty and distress. Sam's has an app that allows you to check yourself out and just walk out the door. So while you're shopping and putting things in your cart, you scan it with your phone and then you walk through an arch on your way out the door and it has your receipt on your phone. It scans your receipt and the items in your basket and they wave if you're good. They just wave you out the door and out you walk. You don't stand in lines at the register or do any of that. Walmart has that app now, but it's not free. So at Sam's, you can't even get in unless you got a membership. So you're already paying for the app. At Walmart, you can shop there without an app. You just have to go stand in line. If you want that app, you have to pay for it. Now, I've argued with my wife. I'm happy to pay it. She's stuck in the mindset that I've never paid to shop at Walmart. I'm not going to start doing it now. To each their own, right? I'm very happy to just scan items as I put them in my cart and just walk out the door and, be on my way, not stand in line and have to scan everything and bag it and blah, blah, blah. Now at Sam's, you don't bag anything, so that's fine. At Walmart, I don't know how that would work. Do you pay for it all and then you stop by and you bag your, I don't know. I haven't got the app, so I don't know. But they are offering it now. And I was just talking to AI about Walmart's online sales. The last time I checked, their sales were 10% of their global revenue. Now it's 18 to 19% of their global revenue. And their US operations e commerce is profitable now. It wasn't, but in 2025, they finally crossed the threshold, and Walmart is now running a profitable e commerce in the US, which explains or helps explain its current levels. How much more money are they going to make from that app, I wonder? Well, I live in the country. We don't, Nobody will deliver to us. I can't use any of those services. The Nothing. Um, if I am strategic about what I order on Amazon, meaning it's going to get shipped from my state and from a neighboring city, I can get 2 day. But I have to be very specific to make sure that it's in my local cities. Otherwise, no. Almost everything. Plus, they always offer me an incentive like, do you really need it or can you wait for Prime Day? And Prime Day is like Wednesday or Thursday. And they pay me to wait. So I'm like, yeah, no, I'm in no rush. I'll wait for. Yeah, I've got a lot of credit on Amazon from that. That's usually where I get my books. I hate buying books. I hate buying books, but I love to read. So I save them up and I buy books. I ordered my motorcycle boots online. And yeah, I talked to somebody about it and they're like, look, I understand you don't want to buy shoes because you want to put them on your feet and see how they fit. But if you are on Amazon, look for the reseller who says you can send them back for free and then read the comments to make sure that others have sent them back and not had any issues. And I did that and I found the most amazing pair of motorcycle boots. I love them. Could not find anything in my area that looked even remotely close. And what I was finding was crazy expensive. I got online, I found this really great pair, and I had no issues with the company whatsoever. There's an app, Temu. I'm sure I'm mispronouncing it. But it's the China app, and you can find all kinds of crazy stuff on it. There is U.S. companies that sell U.S. products at crazy prices because they're the only one with the patent. Well, China like broke into the patent office and stole all kinds of patents. And there's woodworking tools and mechanical tools that you can now get on Temu. You got to be careful because you can get some knockoff that's a piece of trash. But we're talking about like T squares and all kinds of stuff that you can get now from Temu at ridiculously cheap prices compared to the US competitor with matching and or better quality at a third of the price. And I've done it. I got router bits and router tools and squares and all kinds of wood shop tools because we run a wood shop out in the garage. And I wanted some tools that I didn't want to pay the high price for. You know, I got them on Temu and they're fantastic. You got to shop around, and YouTube really helps because people make videos and run comparisons and they'll tell you what's trash and what's not. Just Watch some videos because they'll if it's trash, you'll know, and then you don't have to spend your money on it. I was digging into Walmart. Um, I kind of took my eye off of this one for a while. I took a really big trade in Walmart a few years back. And then after I was in my position and I was continuing to build it out, it was a significant size. They got into a fight with the government over their pharmacies. The government sued them and they sued the government. And I said, well, I don't want anything to do with this. And I unwound my position. It was okay. I made a little money, but I got out, and after all the work I had done, I felt that I lost in the end because, nobody paid me for my time. I had to put all that work in on my own. So it went sideways for a few years while they fought the government. I don't even know how all that turned out because I quit looking. Like there's plenty of things to trade. I don't need to trade this. But look at it. Look at it since that whole 2022 bear market when it ran back up and it's on the run. We consolidated recently, right? In the last year, we had this sideways bit and now we're going again. If we're looking at measure to measure, right, from the last breakout, and we'll even catch it on the drawdown, from the last breakout in consolidation to the next breakout in consolidation. Where's that next one going to be? And I'm going to handicap it just like I did before. So we'll tuck it down below the breakout point. We're looking at 150. I like 150 on Walmart. Now we still need a time factor. There's a couple of ways to get time factors. I'm not a big fan of these two, but there's this GAN fan, and then there is the cycle brackets. I'm not a huge fan, right? But let's run what we have. Well, I'm not going to wait 4 years, so don't like that. Probably it's the monthly chart that's throwing it off, right? I would say it's probably the monthly chart, and then the weekly is just too close. The next big pullback, when the pullback comes, we'll take it less than 100. If we're going to have to stay above 100 to keep things going, then we'll just move this up and look at where the next pullback would be. Mark 100 so we know where we need to go. We need Walmart to at least reach 125 before the next pullback. Otherwise, the next pullback will get below 100, and we don't want to get below 100 now, right? Those monthly levels aren't going to help us. We got to just take all that off. It's way too big. 2029 is too far away. But reverse engineer where the next pullback would be if we want to stay above 100, and that's 125. Walmart to 125 is not out of line. I'm down for that. But getting there very likely won't be a straight shot, right? It's been a bit of a wild ride down into the April lows with the president and the tariffs and all of that, and then the recovery, and now the expansion. We are above the 1.5, and the 2.0 would be 130. So 125 with an overshoot into 130. I can work with that. So how do we trade it? Well, if you can afford the stock, It's not an overly expensive stock. You could consider something like just selling a put, right? Um, that's naked. So you have to be able to pony up the capital for that put, right? It's got to be a cash secured put. If you can sell the put and then buy, no, no, let's not buy, let's sell. Sell a call credit spread at what were we talking about? 125, 130? Yeah, we could do that. So now what are we doing? We're selling calls and we're selling puts. Sounds crazy. This, ladies and gentlemen, is the famous Jade Lizard. It's a popular trade developed by Jen and Lizzie over at Tasty Trades. It's an earnings trade by design, but you don't have to do it that way. You can do it on a whatever, right? So when we sell puts, normally you would do that as a way to get stock. As a buyer, you have rights and you can decide to exercise those rights at any time. But as a seller, you don't have any rights. You just have obligations. And in this scenario, if you sell a put and somebody exercises their right as that put buyer, they can quote put the stock on you. That's kind of where it gets its name, right? So if they put the stock on me, I'm obligated to buy the stock at the put strike that I sold. That would mean I'd have to buy the stock at 515. One not 515, 115. On the other hand, I do have a call vertical that is short. Now, if you can afford it, you can just do a naked call, right? But you got to have a significant account to sell a call if you don't already have the stock. Most brokers are going to say that's an illegal trade. We haven't given you the permission to sell a call negative like that. And they'll ask you to just go ahead and buy the stock first or sell a call somewhere else. So we'll just sell the call with they'll ask you to buy a call somewhere else. And that way you have coverage. So we'll just do both. We'll buy the call and sell the call, and we'll sell a put. And that gives us a trade that looks a bit like this. Now, I don't know how well that shows up in the live stream, but we're going to hide the yellow line because I have found that it's easier to understand this risk graph if we do that. So that all you see is the cyan line, right? That pretty blue. I think it's pretty. He's so pretty. Here is the break even. If the stock price falls below that point, you're now in a losing trade. But anything above that line in the sand is a profitable trade. Now, that's not bad, all things considered. We got a wide moat, right? We got to adjust some things, though, so that this risk graph shows us our risk in a better way. Different brokers have different settings, so you may have to adjust things accordingly. Start with the date of the options that we're trading. These are June. So up here at the top, we want to set this on to June. Use the monthly OPEX. Notice the size of the gray area has enlarged significantly, right? That is the standard deviation. So here's the break even, and we want set base and one standard deviation right here. Notice the yellow lines changed. And again, I don't know how much you can see in the stream, but the yellow lines have now shifted. And we've got a 32.6% chance of closing in this zone and a 35.6% chance of closing in this zone. Add them up together, and we got a 68.27% chance that we'll close somewhere in that gray area. Well, that's not bad, right? But that's not where our risk is. Our risk is right there. So we need to adjust those lines to show us where the bottom falls out. To do that, we got to go back down here to the show actions menu and set this to break even 107.46. As long as Walmart closes above 107.50, let's just round up, then this trade will have some form of profit to it. And it doesn't matter how much higher Walmart goes. It doesn't even matter if Walmart falls down a little bit. As long as Walmart doesn't fall below 107 and a half. We can add a slice right where Walmart's current price is, and that's basically 117. So we could fall $10. Not bad, right? Like $9.50, and we would still not be losing in this trade. Kind of gives you a chance to look at Walmart in a whole new light. Do I know for sure that it won't fall down? No. But what would it need to reach 107? 107 and a half. It would have to close this gap on the weekly, break this pivot, and then continue to fall and come down and hit me at 107 and a half. As long as it doesn't do that, I'm in a winning trade. Time has to go by. This trade won't make money unless time passes. Let's see what's happening in the news. Thanks for the heads up on that. Trump is out there chipping his teeth about the dollar. Well, we're not we're not using puts in its normal way, right? The typical put trade would be to buy a put and make money as the stock falls. What we're talking about doing is selling a put, which will make money as long as the stock doesn't fall lower than the put we sold, and will help make our money faster if the stock rises farther away from the put we sell, right? So we're talking about a short put. Sell to open instead of buy to open. Yeah, it does require margin and or, you know, capital. They'll want that money up front. If you couldn't buy 100 shares of the stock, then it won't let you sell that put. That's what it's going to use as its metric. And then it has this funny little calculation. So say we sell the stock or we sell the put at what did I choose? 115. It's going to ask, do you have enough money to buy 100 shares at $115 a share? But then it's going to add a little bit on top of that and say, okay, you need to have that much money plus a little bit more. So the real buying power, and then they'll subtract buying power because of the credit on the call side. The buying power would be, in this case, $11,245. So as long as you have basically 11.2, you're good. Let's call it 11.3, right? $11,300. Then you could take that trade. The max profit, if everything went perfectly, is 757. The the bad thing is how they show loss. They say, "Oh, you could lose $10,700, which is absolute BS. Let me explain why it says you can lose that much money. Notice this side doesn't flatten out. It just keeps going. Well, if Walmart fell all the way to zero, then you stand to lose $10,400 or whatever that number was. Who in their right mind would see Walmart falling? Say, I don't know, they get caught running sweatshops and killed a whole family of people like Boeing when airplanes fell out of the skies, right? Say it did. It won't go to zero in a day. You would know that it's going down and you would be able to get out. Nobody would hold this to zero, right? Nobody. Maybe as it's falling, you die of a heart attack and your family can't log into your account and you end up holding it all the way to zero. That's the only way that I could see it, right? And you'd be dead, so you wouldn't care. So that $10,000 loss should never be shown to people because it just scares them. It freaks them out. And they say, why would I want this trade? It's risking $10,000. No, it's not. No, the trade is not risking $10,000. It's risking capital. If Walmart falls below 107, then you're at risk and you would need to close the trade. Yes, but not $10,000 worth of risk. That's just silly. So right now we have a $10 buffer basically. And even if the stock did go below 107, as long as it rises back up above 107 before it expires, the trade is still good. That's not some, stop that kicks us out of the trade. So we can get back above it if things got bad. So what we want to do is mark those lines on the chart. We can tell the platform to do that. So we just come in here, set slices. First, we set them, make sure we got them in the right spot. We want break even because when I was clicking around, I could have moved it. So we set it at break even, and now we set those slices on the chart, and there is our line in the sand, right? There's our break even. If you don't name this line or change its name, if you give it any more commands, it will erase that line and give you new lines. So now that I've renamed it, I can go in and I can change where that line is. So now let's do the base plus 1 standard deviation. So now we have that. We don't really need the at the money line. So I'm going to get rid of that. And we'll put those lines on the chart. Now we've got those. We don't really need this bottom side, but we'll keep it. That's the SC low or the SD low. Set that on the right. This one is the one that I really wanted. Oops. So now we got 1 standard deviation high and our break even. It's unlikely that we'll get above 140 before the expiration of these contracts because that's our standard deviation. That's how far the market should move if it's moving normally. If it gets crazy bullish, we could outrun that level, but that's unlikely, right? We don't want to anticipate bigger than average move. To the downside, if it did break our break even line, we have the 1SD low, and that again is the lower edge of how far the market should move if it's moving normal. So there's our 1 standard deviation, and there's our break even. And this one trade has the opportunity to make money the most in this range. And even as a consolation prize, we could make 255 if we did overshoot and end up here somewhere. So not bad. I don't usually run these to max profit, by the way. I like to run them and take profit along the way, especially if I get to adjusting things. So what could be adjusted? Well, we got the short put. Let's suppose at earnings, the stock pops up to 130. Remember, we need time to go by, and that this trade won't make money just because the stock moved. So it jumps up there. That makes our calls begin to lose money, but it makes our short put make money. And the trade pretty much balances out, and we still haven't really got any profit to speak of yet. We need time to pass. So, in that jump, since it's going to make our puts profitable really fast, but the profit got offset by the calls, roll those puts up from like 115 to 120, maybe 125, but I wouldn't want to get too close. Just 5 points should give us a little bit of money. How much money? Well, look at the 115. Right now, it's trading for the split between these two. The split is 620. If we rolled that to the next level, which would be 120, we make $200. So we could get $200 of risk out of the trade, bring those puts up a little bit. And then, of course, what happens after earnings move when the stock makes a fast jump? It generally backtracks a little bit. That will get those calls to calm down. Maybe we can roll them, maybe not. But if we did get that initial leap, we'd be able to bring those puts up, make a little bit of money on those. So we can get more than our 755. I think we could get quite a bit more depending on how we play it out. But this J Lizard is a wide moat play, right? Like, look at all that room. As long as it doesn't fall $10, we're good. That's one of those trades where we don't need momentum, we don't need trend. We just need a pretty good idea of where structure is and have the confidence that it's going to stay above that structured level. I don't know. I like this one. If you play momentum, you'll make more money, right? If you can buy a call when the stock is running or buy a put when the stock is falling, sure, those will certainly pay you better. This doesn't require momentum or trend or a trade signal, right? Like we don't need a breakout or some 2 bar reversal or a hammer or we don't need anything. And that's nice. Sure, you don't make as much money, but you don't have such a tall ask either. Normally, the ask for a trade is a lot greater because we do typically need a pattern and a setup and a trade trigger and momentum and inertia, and we don't need any of that. Now, at any time, if the stock falls below the break even, what are some of the things that we could do? Well, one of the things that we could do is we could just close that put, right? We could just buy it back. I don't like that idea. And I probably wouldn't buy it back. The problem with the stock falling down to 115 is that the price of that put is going to rise to the at the money put price, right? If we fall to 115, that's going to jack that options price up by a couple $100. You can avoid paying that if you just don't touch the option at all, let it expire in the money and get assigned the stock. I'm not scared of Walmart stock. Wouldn't bother me to have it. So then you don't have to buy the put back at an accelerated price and at a loss. You can just take the stock. So then the other side of the risk is the call spread. Now, I didn't make the call spread very wide because this was more of a demonstration than anything else. And I didn't necessarily shop around for the best calls to sell. We could sell a different expiration. We could look up and down the options chain to find something with more open interest, maybe better bid ask spread. There could be a much better call vertical to sell than the one that I picked. There could be, right? I just picked those because they looked okay. There wasn't anything radically wrong with them. That's the 125, 130. And we can see, a decent amount of open interest here. Well, when it comes to the put, since you're the seller, you don't get to exercise it, right? Now, you could certainly reach out to the broker and ask them, but otherwise, as the seller, you have obligations and the buyer has the right to exercise that put. The only thing you can do is hang on and let it expire in the money and then have it assigned automatically just because it closed at expiration in the money. And your broker will actually reach out to you in advance before it expires and it'll send you an email and say, "Hey, you got an option in the money. And if you don't manage it, you're going to end up getting exercised." So they'll warn you in advance. Some brokers won't let it go and they'll kick you out of that trade. So depending on who your broker is, you may need to reach out and tell them you actually want the stock. Like Tasty Trade, um, they'll auto manage it and they won't, they think they're protecting you. And so they'll kick you out before you actually get the shares because they think you don't want the stock. So you would have to reach out and tell them, "Hey, I do want the stock." There's a strategy called the wheel where you sell puts to get stock. That's the start of the circle. So you sell puts to get the stock, and then eventually you do get the stock, and then you sell calls to get rid of the stock, and eventually you lose the stock. And then you start the whole process over again in a circle, and that's called the wheel, right? It's a really good fixed income strategy. Um, it's sleepy and slow and boring, but it's a great way to make money. Way less risk and less stress and all, less everything, but less money too, because you do make more picking a direction, obviously, right? But it's more demand. You need more trade knowledge. You got to be nimble, flexible. This way, it's slower, more relaxed pace. You can stack a whole lot more on because, things move slower. So you can have a lot more trades as long as you have the capital to manage them. I typically carry 300 to 500 trades at any one time. They're not all wheels. My goodness, no. But, having a lot of trades on is kind of normal for me. And I don't sit there and stare at every one of them all day long. Some of them I don't check on for days or weeks. They get closed sometimes. I don't even know they're closed. It's not like I check all my emails every day. I'll just randomly open one of my accounts, like, oh, shoot, yeah, look, they closed that one. Huh, okay, done. Move on to the next one. So if they're slow and sleepy, that makes it easier to manage more of them. It's one of the reasons that I like to annotate on my charts to draw out a trade just like we did here on Walmart. So that say I get this trade and it's for June or July, I think it's July, June, but it's a long ways from now. I know me, I don't remember what I had for dinner last night, let alone remember what this trade is a week from now. If I put on a trade like this, I'm liable to forget it for days or weeks. And yet, if I come back to my Walmart chart, A, I'll see my lines, and B, instantly be able to recognize, hey, how's my trade doing, anyways? I won't need to go to my portfolio and look at the trade. This chart tells me exactly what I have. And if this isn't enough information, then I add more information. You can put your premium on here with a note, or you could add extra levels if you got in at different prices. Annotate that chart to have all the information you need so that at a glance you can bring up that chart and you know exactly what you need for that trade to be profitable, and you don't have to go in and, do a deep dive on your portfolio just to figure out, hey, what the heck am I holding here? It's easy to manage one trade at a time, or two or three. You get into the hundreds, this sort of stuff will really save you a lot of trouble and headache. So it's not a bad trade. I don't mind it. Um, since we're on the sell side in both of these trades, it probably wouldn't hurt to find something with a little more volatility to do that kind of a trade. It's not to say that the Walmart one that we were looking at is bad, because it's not. There's nothing wrong with this one. Just the same tactic could be applied to something that is perhaps a little more volatile, that would offer a little more premium, right? Because the price of the options that we're selling dictate how much money we're going to get in the trade. So if you was to do this on, I don't know, Ford or AT&T, there is no money here. Sure, it's a really cheap company, but look at the price of these options, 20 cents, 30 cents. There's nothing here. And look at the price of something like Snow, $200, $200 stock, $8 options. It's not fantastic. Intel, no money. Nvidia, not really. So you could shop around and perhaps find a stock with better premiums, but Walmart's not a bad example. Plus, I don't know, I like it as a company. I think they've got a lot of upside potential through the 2026 year. Resolve AI. Yeah, there's a turd. All right. IPO price is here and we are underneath that automatically. That makes it a bad long term trade. It has yet to shake out whatever trouble it's in. Um, for me personally, I don't take long term options trades on things that are less than $10, because there's not a lot of options to work with when it's less than $10. So if we were to go in and look at this, it has weeklies. That's a good start. Take it out to March or April. Yeah, look at how absolutely cheap these are. There's just no premium here. Then there's bag holders. So you don't have a lot of strikes. You've got one strike, and that's this $3 strike. This $2.50 one is trash. That's a bag holder. That's a bag holder. These are people just begging someone to buy those options, right? Just please come in and save me. Don't save them. Don't don't say, let them crash and burn. If you look at the call side, that's basically the only one that has any trades at all, and it's only these top two. So in total, you've got three strikes to trade. That's trash, 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 trash. Maybe that $5 one has a little bit, maybe, but I would say no. No. So it's another really good example of just a really bad opportunity. It looks like they're trying to stack it in a little bit. If you was to try to trade this, you're basically making book. You're going to be an options dealer at that point. I'm not interested in being an options dealer. That's the problem with being too cheap. There's nothing on the put side worth even messing with. Good rule of thumb, check its IPO price, make sure you're not underneath it. Otherwise, it's a recovery trade that hasn't even proven that it's going to recover yet. All right, guys, it's after 4. Remember, tomorrow I will not be running the afternoon stream, but I will be back on Friday. I'll see you at the morning briefing because the morning briefing is not a problem, right? I will always do that. Just not going to be doing the afternoon live stream. So be careful tomorrow. And of course, I'll be in the chat. If you have ideas for topics or questions or just want to chat, we'll be here Friday, and the replay will be in the replay channel. So always appreciate you guys. I hope you have a good week, and I'll see you all in the morning.